Hey everybody, it is Chuck Barone. Thursday, September the 5th, 2024. Rocking and rolling on the chat. P.S. Dave, my broker is licensed in Florida. We can do loans in Florida. All right. Anyway, you guys see these markets today? Another weird day and a weird week and a weird month and the weirdest freaking period in these markets I've ever seen. The crazy stuff, guys. Just bananas, man. It seems like every day we get a new surprise. Every day there's some more new conflicting bits of data that are coming in that completely confuse the crap out of everybody. It's like, it's soft landing, recession, quarter point, half point. There's just so many swirling things going on right now. It's bananas. It's crazy time. Anyway, before I get ranting, let me take a half a second. As always, welcome everybody to the show. Thank you guys for your support. Thank you, a special thank you to the guys on the chat who keep that chat going. Really appreciate it, guys. And let's get off on talk about markets today. So we got some little bit of data today. Nothing I saw that really should have freaked these markets out, and they really weren't. Um, More neutral data. We'll go through that piece by piece here in a minute or two. But nothing really earth shattering today. So the markets were kind of mixed. It was a weird day. So the stock markets. So the Dow gives back some of those gains, down 219 points. 40,255 on the Dow. Still a huge number. I mean, the Dow's pretty close to record territory. The NASDAQ actually gained 43 points today. It seems to be going the opposite of the way the S&P and Dow are going these days. Not so. So up 43 on the Nasdaq, 17,127. The S&P falls 16 points, 5,503 on the S&P. So basically, not much of a day in the stock market. Today, tomorrow is the day, guys. Bond market, another weird anomaly. So the 10-year bond yields falling today. So people buying bonds today. The 10-year falls 4 basis points, now sitting at 3.73%. The 2-year falls 2 basis points, now sitting at 3.74%. So now we had the boop, we had the inversion. Then yesterday was the reversion, and today we're back to the inversion. But again, by the narrowest of margins, 1 basis point separating the 2-year and the 10-year. Crazy, man. Bond market. The dollar today gets beat up a little bit, down 20 basis points, 101.09 on the dollar index. Looks like the dollar's going to get back down and try to bounce off 100 again, guys. These short sellers, kind of a lot of pressure on the dollar, especially now today with this ADP report that came, private sector jobs. So it was just dollar. Hopefully, we'll get a little bit of a bounce here. Precious metals today rally up. Gold, $20.40, $2,516.60. So gold leaps right back above 2,500, no problem. Silver rallies up 49 cents, $28.73. Come on, silver. Come on, silver. You can do it. You can do it. I sure would like to see silver get and hold $30, man. That's the number. And it's been diddly dallying around with it. Can't get above, can't stay above. As every time it approaches it gets beat right back down. We're on our way back up again. Let's make another run at it. We'll see what happens. Oil today, flat. No change in oil on West Texas Intermediate. At least the last time I saw it might have changed by now. Might have changed now. Price flat, $69.20 for a barrel of West Texas Intermediate, right where we kind of expect it to be, guys. There's plenty of supply. The demand isn't as strong as they were thinking it was going to be. We already got OPEC starting to get a little bit nervous. So we'll see where oil goes. But right now, I think it's priced about right where it should be. Bitcoin today falling down $1,768, sitting at 56,152 for Bitcoin. Looks like Bitcoin's going to go down and try that, test that support number at around 52,000 again, guys. And we'll see. But every time it's gotten close to that support number, it's bounced pretty strongly. Let's see if it's got the wherewithal to do that again. Go Bitcoin. All right, so let's talk about data today. A whole bunch of crap, man. Jobless claims. That was 5:30 this morning. Jobless claims fall 5,000 this week, 227,000. Continuing claims also fall. So there's really no sign of mass layoffs or big scary stuff going on with jobs. Layoffs low, hiring slow, right? Some say that this kind of makes the case for a quarter point cut. Nothing, it's kind of, in my mind, I don't know, man. They say that they think it should kind of confirm a quarter point cut. Labor stronger than they thought it might have been with last month's jobs report. Seems to be hanging in there. Now, in my mind, and this is a neutral rate, guys. This is a neutral result here. I don't think that this jobs report coming in the way it did today, this unemployment jobless report, jobless claims, whatever, coming at this number today, I do not think is going to affect their thinking in any way, shape, or form as far as rate cuts go. I just think that, they've kind of, I'm guessing most of them have kind of made up their mind where they want to go, right? And this number is not going to change anybody's mind. But the good news is labor, we've been getting some mixed signals there too. Labor seems, and we got more because I'm going to talk about ADP next, right? So weird signals in the labor market seems to be weakening. But then we get data showing that it isn't as weak as we thought it was going to be or could be. So we'll continue to monitor that obviously very closely. ADP comes out with their jobs report today. Jobs report, they say 99,000 jobs in the private sector in August. Economists had expected 150,000 jobs, so that's a pretty big miss there. So this sets up tomorrow's job report just perfectly, doesn't it, guys? Jobless claims fall. New hiring also falling pretty bigly. Now, this ADP's private sector doesn't include any government stuff, but a big miss, they missed by more than a third. Tomorrow, Bureau of Labor, non-farm, expecting 160,000 jobs for August. If they miss like this ADP report, now ADP seems to miss way more than the Bureau of Labor does. Although Bureau of Labor got whiffed pretty bad last month, right? So I think that depending on this number now, in my mind, the way the number comes tomorrow, the jobs number tomorrow, if it's pretty much what they expect, I think we're going to get a quarter point cut. If it's way stronger than they expect, I think we'll get a quarter point cut. But if it comes in like this ADP report does, if it's way worse, if it's like last month they're expecting almost 200,000, they got 112, right? So if tomorrow's report, they're expecting 160, if that comes in like this ADP report saying 100,000, I think then we could possibly see a half point cut in September. So this jobs report tomorrow, in my mind, is going to set the rate cut for later on this month when they have their FOMAC meeting. I know it's kind of weird, but they're so data dependent right now, and the rest of this data is so murky. I think they're going, the inflation numbers are going their way. We'll see what happens this month with CPI and PPI, but inflation going their way. Now they're kind of turning their focus from inflation to jobs. And I think they're going to try and do what they can. That seems to be the focus. So we'll see now, quarter point, half point. That's the big question. Labor costs today, we got their report rising at a much slower pace than they estimated. And worker productivity for the second quarter jumps. So workers kicking ass, productivity up big time, wage gains slowing. Hiring, obviously, I think the wage gains slow with the hiring slowing, right? So less jobs, more people competing for the jobs. Businesses can pay a little bit less to get the best prospect. If there's a lot of jobs, they got to pay a little more to get the best prospect. So it looks like wages are kind of wavering, but at least we've had a little bit of wage gains. And according to the government, wage gains higher than inflation, not in real estate, guys. But anyway, so here you have it. So the economy, again, it's just all mixed signals, right? So which is it? Jobless claims were right where they expected them to be, or ADP shows nobody's hiring. They missed by 33%. Now you get labor costs finally falling, which is what the Fed was tripping on about these sizzling hot jobs reports, right? So now they got their wish there. Productivity is still going up through the roof, which means companies will only get to be more profitable because they're certainly not going to share very much of that productivity gains with their employees. So it's really just a huge mixed bag of what the freak, man. Okay, so listen to this. Remember I was telling you guys we're going to get all the Fed people out this week, right? Especially now it looks like what they're doing is they're shoving all the dubs out. Yesterday we had what's his name, Boskin from Atlanta. Today we get San Francisco Bank President Mary Daly. She says rate cuts are needed to keep the labor market healthy. So she's telegraphing the change in their focus from inflation to the labor market, right? She says how much rates will be cut will be determined by the incoming data, which I think confirms what I was saying. Tomorrow's data is going to determine the size of that rate cut. She said the Fed right now, and kind of showing a little bit of urgency to get these rate cuts started. And she's a super dovish, she's a low rate person. So I'm guessing she would be in the let's cut a half point camp. She says right now, the Fed is following a basic recipe for over tightening. So she's basically saying that they need to hurry up and start cutting rates or they're going to get behind the curve on this stuff. And because rates are so high, will be a catalyst for driving unemployment higher. So I'm telling you, man, it sucks to be a Fed person right now. It really does. Imagine you're in that room with all these knuckleheads, right? And they're trying to figure out rates. So which way would you go, guys? You're looking at these inflation numbers, and they have way, way, way more detailed numbers than we do. You're looking at inflation, you're not on target. Now, and truthfully, PCE has kind of been stuck there at around 2.5 for a while, right? It was 2.5 or higher. At least the core came down a notch, but that's it. So the inflation number is still a little bit elevated, but now you got this jobs thing coming. So if you're a Fed official, which way you think you would go? You think you would be for a 1/4 point cut? Would you be for half a point cut? Let's get real estate working again. Would you be for no cut at all? Let's focus on getting the job done on inflation. We can always lower rates later to rally the economy and fire jobs back up. Especially when we got a big seasonal hiring surge coming with Christmas. So it's just a fascinating time. Interesting to watch these Fed officials. Now, I'm sure what will happen is, well, maybe not, because tomorrow the report's going to be there. I really thought we would get more Fed people out talking this. Goolsby was out today, too, and a few others. But, and I got to say, I've been right about a lot of stuff, man. I nailed oil. I've been talking a lot of the advice we've been given on the show. If you're following that advice, you're doing pretty good right now. But the one thing I missed on, guys, and kicks my own ass, is I really figured that the inversion would lead to a recession. I've never been a big believer in this soft landing stuff, right? We've nailed the price of oil. We've been cheering on gold and silver. We've been pretty much right on a lot of stuff. But I think that, it's going to, the closer we get toward the madness of the election, the harder all of this stuff is going to be. But I got to say, I would be in the, even because it looks like the Fed is determined to cut rates. Me personally, I would be in the, we're not cutting rates. That's where I would, if I was a Fed official, that's what I would argue. Let's get inflation below our target. Let's let the people know we're going to take one of these mandates seriously. You can't have two mandates. And now, even though this one isn't where you want it to be, now you're going to change your focus to this one because it's not where you want it to be. No, let's get the inflation in order, man. It's not like we're having mass layoffs. The jobs market is going exactly where the Fed wanted it to go. They wanted it to slow down, and it has. So, yeah, tomorrow's jobs report, hugely, hugely, hugely important, guys. All right, investors, let's go real estate for a second. Investors snatching up more than 30% of all single-family homes for sale. So the investors are still in there. It's almost all institutional, guys. And what they're doing is they're making this market a giant, massive mess for everybody but them. Because they don't really care if they overpay for a house. They just don't. But what they're doing is they're focusing their fire on the bottom of the market. So they're buying up all the starter houses. If you figure the entire real estate market, I would say maybe 50% of the houses are basic starter houses, 3 bedroom, 2 bath, 2 car garage, kind of, 1,200 to 1,700 square feet, somewhere in there. And then, the rest of it, the other half would be houses that are bigger, fancier, or condo, townhouse kind of stuff. So they're snatching up of the single family residence part of it, almost all the starter houses, because those are going to be, number one, the easiest to rent because they're going to have the lowest rents, and they're the easiest to buy because they have the lowest price to buy them. But they are the ones who are making a mess of it for first-time home buyers. And I don't care how anybody reads it, you're never going to have a healthy real estate market without first-time home buyers in that market. They're first-time home buyers of the future of the real estate market, okay? The old people own all the property right now. Well, what good is it? Young people can't afford to buy the McMansion, so the old guy can downsize. Plus, older people are deciding not to downsize way more than they used to. And I guess they're staying healthier longer, so the stairs in the house aren't the big thing they could be, if their health was poor. But investors, man, I think that as much as I hate to say the government needs to get involved, we need to have some kind of rules for this investor class. When you got a company like Blackstone or BlackRock or friggin' KKR or Carlyle or Pinnacle or all these giant private equity groups, they have so much cash. It's not even close fair competition. And they can single-handedly drive prices, which is exactly not exactly fair play, which is exactly most government rules for investing are written. So the big can't have the big advantage over the small. Well, now it's time to move that not only from securities and all that other stuff, but now it's time to set some rules for the road of real estate investing. Hopefully, because again, I'm very reluctant to say that the government should get involved, because when they do get involved, they usually end up making things worse rather than better. But we need to have some kind of limit on investors, at least right now, in these markets, because they're just making a giant mess of these markets, and they're going to make the government's job 20 times harder later. And if they ever all decide to stampede out at the same time, that's going to be a lot of fun. Anyway, guys, that's it for the day. Tomorrow's the monster. Tomorrow's the big one. Make sure you're here tomorrow. Of course, I will be. Hit the thumbs up on your way out, guys. It changes the algorithm. It helps the show get more views, and we need those views, man. We're looking like crap right now. Love every single one of you guys. Special thanks to all the guys on the chat today. You guys are cool. Oh, I got Ed Sullivan on there today, Kevin, and a few others. Nice. All right, guys. Anyway, that's it for the day. We'll be rocking and rolling tomorrow's The Monster. Until then, everybody, have a good one. Take care. Thanks.